In today's world of personal finance and investing, two of the most popular vehicles for building long-term wealth are mutual funds and exchange-traded funds, or ETFs. While both offer a way to gain diversified exposure to various assets such as stocks, bonds, or commodities, they differ in structure, costs, liquidity, and flexibility. For new and seasoned investors alike, understanding the key differences and advantages of these financial tools is crucial to building a smart and balanced portfolio. This video explores everything you need to know about mutual funds and ETFs, including how they work, their pros and cons, and tips for choosing the best option based on your investment goals. What is a mutual fund? A mutual fund is a pooled investment vehicle managed by professional fund managers. Investors buy shares in the fund, and the fund's assets are used to purchase a diversified portfolio of stocks, bonds, or other securities. Alright, let's talk about some key characteristics of mutual funds. First up, active management. Many mutual funds are actively managed, which means fund managers are making regular decisions about buying or selling assets on your behalf. Next, there's NAV pricing. Mutual fund shares are priced just once a day after the market closes, based on their net asset value, or NAV. Another thing to keep in mind is minimum investment requirements. Most mutual funds require you to invest at least $500 to $3,000 or even more to get started. Then there's the difference between load and no-load funds. Some funds charge a sales fee, this is called a load, when you're buying or selling. Others are no-load, so you won't have to worry about those extra charges. So, what exactly is an ETF? An ETF, or exchange-traded fund, is actually pretty similar to a mutual fund since it holds a diversified basket of assets. But here's the main difference. ETFs are traded on stock exchanges just like individual stocks. That means you can buy and sell them throughout the trading day, which gives you a bit more flexibility. Now let's look at the key characteristics of ETFs. Most ETFs use passive management, which means they track a specific index like the S&P 500. Although, actively managed ETFs have become more popular lately. Another important point is real-time trading. ETFs are priced and traded throughout the day, just like stocks, so they're a lot more flexible. Also, you can get started with very low minimums, sometimes as little as one share, making it easier for small investors to jump in. And finally, ETFs usually have lower expense ratios compared to mutual funds, so you might end up paying less in fees. Alright, let's talk about the key differences between mutual funds and ETFs. So, mutual funds are typically bought or sold at the end-of-day net asset value, whereas ETFs are traded throughout the day on exchanges, just like stocks. When it comes to management style, mutual funds are primarily actively managed, though there are some passive options, while ETFs are usually passive, but you'll find a few actively managed ones out there too. Expense ratios are another big difference. Mutual funds generally have higher fees, while ETFs tend to be more cost-effective. Tax efficiency is also worth noting. Mutual funds are usually less tax efficient, whereas ETFs are designed to be more tax-friendly. Minimum investments for mutual funds are usually somewhere between $500 and $3,000, but with ETFs, you can often get started with just the price of a single share. And finally, liquidity. Mutual funds settle in 1 to 2 business days, but ETFs can be traded immediately during market hours. Let's walk through some of the advantages of mutual funds. First up, professional management. Investors get to benefit from experienced managers who are making research-based investment decisions, especially in those actively managed funds. Next, diversification. A single mutual fund can hold dozens or even hundreds of different securities, which really helps spread out your risk. Another perk is automatic reinvestment. Many mutual funds let you automatically reinvest your dividends and capital gains, which can help your investment grow over time. And finally, mutual funds are ideal for long-term investors. They're a really good fit for retirement accounts like IRAs or 401(k)s, where you're not looking for daily trading flexibility. Now, let's cover some of the disadvantages of mutual funds. First, higher fees. Actively managed mutual funds often come with expense ratios above 1%, and some even charge sales commissions. Another drawback is the lack of intraday trading. investors can't take advantage of market fluctuations during the trading day. Then there's tax inefficiency. Because of turnover within the fund, capital gains may be passed on to investors, which could create a tax liability for you. And lastly, the complexity of fees, things like load fees, redemption fees, and 12B-1 fees, can add extra layers of costs that you'll want to keep an eye on. Alright, let's talk about the advantages of ETFs. First, low cost. Because most ETFs are passively managed, their expense ratios are often as low as 0.03%. Second, liquidity and flexibility. You can buy and sell ETFs anytime during the trading day, just like a stock. Third, tax efficiency. ETFs typically use an in-kind redemption process, which limits capital gains taxes. Fourth, broad variety. ETFs are available for nearly every asset class and strategy: stocks, bonds, commodities, sectors, even crypto-related assets. And finally, no minimum investment. ETFs are accessible to almost anyone. You only need enough money to buy one share. Now let's look at some disadvantages of ETFs. First, trading costs. Even with low expense ratios, buying and selling ETFs may incur brokerage fees, although these are decreasing with commission-free trading platforms. Second, bid-ask spreads. Thinly traded ETFs can have wide bid-ask spreads, increasing trading costs. Third, complexity-leveraged and inverse ETFs can be risky and are not suitable for most long-term investors. And fourth, less active management. While passive investing suits many, some investors prefer active management during volatile markets. So, which is better? Mutual funds or ETFs? Well, the choice between mutual funds and ETFs really depends on your personal goals, investment style, and preferences. Choose mutual funds if you want professional active management. They're a good option if you're investing in a retirement account. You might also prefer mutual funds if you like automatic investing or reinvestment. And well, if you're okay with higher fees for potentially better performance, mutual funds could be a solid choice. Choose ETFs if you want low-cost, tax-efficient investments. They're great if you like real-time trading flexibility. If you're starting with a smaller investment, ETFs might be more accessible. And if you're interested in thematic or sector-based investing, ETFs can really give you that targeted exposure. So, how do you evaluate mutual funds and ETFs? Well, before you invest in either, consider the following. First, expense ratio. Lower fees mean more of your money is working for you, and even a 0.5% difference really adds up over time. Second, performance history. Look at past performance, but keep in mind it doesn't guarantee future returns. Also, check how the fund performs against its benchmark. Third, holdings and strategy. Know what the fund or ETF invests in. Read the prospectus and make sure you understand the strategy. Fourth, fund manager or index. For mutual funds, research the manager's track record, and for ETFs, understand which index it's tracking. Fifth, tax efficiency. If you're investing in a taxable account, consider the capital gains distribution history. And finally, liquidity and volume for ETFs. Make sure there's enough daily trading volume to avoid large bid-ask spreads. Alright, so let's dive into some real-life examples. So, when we talk about the Vanguard Total Stock Market Index Fund, there are actually two main versions, VSAX and VTI. VTSAX is the mutual fund version, and it does require a minimum investment of $3,000 to get started. On the other hand, VTI is the ETF version, and there's really no minimum investment beyond the price of a single share, which is about $250 as of the middle of 2025. Both of these options track the same index, and they offer, honestly, almost identical performance and exposure. Fidelity Contra Fund, ticker symbol FCNTX, is, an actively managed mutual fund that's really well known for its long-term growth performance. The expense ratio is about 0.86%. This fund is honestly best suited for investors who are looking for active management in large-cap growth stocks. Spider S&P 500 ETF, or SPY, is actually one of the most traded ETFs in the world. It tracks the S&P 500 index with very low fees, around 0.09%. so it gives you quick and easy exposure to 500 of the largest US companies. When it comes to mutual funds, there are some important tax considerations to keep in mind. Mutual funds may distribute capital gains, even if you didn't actually sell your shares, so they're generally a better fit for tax-advantaged accounts, like an IRA or a 401k. Now, ETFs are usually more tax-efficient thanks to what's called the in-kind creation and redemption process. This makes them a better choice for taxable brokerage accounts, where minimizing taxes is, pretty important. Let's talk about the rise of target date funds and ETF portfolios. Many investors choose target date mutual funds for retirement because these funds automatically adjust their asset allocation as you get closer to your goal. On the flip side, ETF portfolios, like the ones you might see from robo-advisors such as Betterment or Wealthfront, offer similar features, but with lower costs and some extra tax advantages. Both mutual funds and ETFs are excellent investment vehicles, and honestly, the right choice really depends on your goals, account type, and investment philosophy. For many investors, a combination of both might just offer the best of both worlds. Low-cost ETFs for your core holdings, and select mutual funds for some strategic active management. So, quick summary here. Use ETFs for flexibility, low cost, and tax efficiency. And use mutual funds if you want hands-off retirement investing with some professional guidance. Here are some action steps you can take. First, review your current investments. Are they cost-effective? Next, determine your investment goals and timeline. Then, compare funds using tools like Morningstar or your brokerage's platform. Decide whether you value cost, flexibility, or professional management more. And remember, you can start small and diversify. You don't have to pick just one. Whichever route you choose, consistency, patience, and really understanding your investment vehicle are key to long-term financial success. Don't forget to like, share, and subscribe for more financial tips, news, and advice.